dollar isn't falling by accident. This is structural realignment. In the next few minutes, I'll show you three things: what changed in the currency architecture, why that change rewired precious metals pricing, and what it forces next across every asset class you're tracking. Headlines are focused on tariff speculation and Federal Reserve commentary. That's the public story. But underneath that noise sits a technical adjustment in how dollar liquidity moves through settlement windows, and that's what actually changed the incentive structure for institutions holding long positions in industrial metals. January 26th marked the moment when 3-month forward pricing on dollar index futures crossed below spot for the first time since the summer rally. That detail changes the interpretation. The lever here is forward rate parity breakdown. When futures trade below spot in currency markets, it signals that institutions expect weaker future value despite higher nominal rates. This isn't about Federal Reserve policy statements. This is about capital repositioning ahead of liquidity windows that close in March and June. Settlement cycles matter more than speeches. The dollar index traded at 97.4 on January 28th, a 4-month low, but the forward curve inversion started 14 days earlier. That's the mechanism driving reallocation into hard assets, and silver is the most liquid expression of that trade. Forward rate parity is supposed to lock in predictable pricing between spot currency and future delivery. When that relationship breaks, it means one of two things. Either interest rate differentials no longer compensate for expected depreciation, or institutions are pricing in events that haven't been announced yet. Right now, both conditions exist simultaneously. The Federal Reserve held rates steady at its January 28th meeting, exactly as expected. But 3 hours before that announcement, the dollar fell another 0.5%. Markets weren't reacting to the decision. They were confirming a position already taken. That's the difference between price discovery and price confirmation. Discovery happened 2 weeks earlier when forward contracts first inverted. Everything since then has been confirmation. This matters because silver doesn't trade in isolation. It trades as the reciprocal of dollar strength, amplified by industrial demand, fundamentals, and speculative positioning. When the dollar weakens, silver gets cheaper for foreign buyers holding euros, yen, or yuan. That increases demand. But when forward curves invert, it signals that dollar weakness isn't temporary, it's structural. And that changes buying behavior from tactical to strategic. Instead of timing short-term dips, institutions start building long-term positions. That's what shifted in January. The buying pattern changed from opportunistic to systematic. First, China announced silver export licensing on December 30th, limiting authorized exporters to 44 companies for the 2026 to 2027 period. Companies needed to demonstrate 80 tons minimum annual production capacity and maintain credit facilities above $30 million. That was the regulatory shift. Then, on January 1st, those restrictions went live. Silver jumped from $61 to cross $73 in the first week. The licensing framework doesn't impose volume caps, but it creates choke points. Refiners now need 2-year permits, and that extends lead times for industrial buyers sourcing photovoltaic panel inputs and semiconductor substrates. China produces roughly 17% of global mined silver, but controls closer to 60 to 70% of refined silver exports through its processing infrastructure. That's the asymmetry. Raw production is distributed globally across Mexico, Peru, China, Australia, and Russia. But refining capacity is concentrated. When China implements licensing, it doesn't restrict what comes out of the ground. It restricts what moves through the processing bottleneck. And processing is where industrial-grade silver gets produced to specifications required for solar panels, semiconductors, and electrical contacts. You can't substitute lower-grade material in those applications. The purity standards are non-negotiable. So when 44 companies receive licenses and the rest of the refining sector gets locked out, it doesn't matter if mine production stays constant. What matters is processing throughput. And processing throughput just became a managed variable instead of a market-driven output. That shifts pricing power from producers to processors, and from processors to the licensing authority. It's not a ban, it's a valve. And valves can be tightened incrementally without ever being fully closed. But that's not the real pressure point. Third, CME Group shifted margin calculations on January 9th from fixed dollar amounts to percentage of notional. Silver futures margins moved to 9% of contract value. When silver traded at $70, that required $6,300 per contract instead of the previous fixed rate. Fourth, silver broke $100 per ounce on January 23rd, the first time in history. At that price level, margin requirements climbed to $9,000 per contract under the new methodology. Fifth, Bloomberg Commodity Index rebalanced on January 9th, cutting silver weighting from 9.6% down to 3.9%. Passive flows tracking the index had to liquidate positions regardless of outlook. That forced selling created downward pressure even as fundamentals tightened. The margin shift from fixed to percentage-based isn't just an administrative change. It fundamentally alters the risk-reward calculation for leveraged traders. Under the old system, margin stayed constant regardless of price. A trader putting up $7,000 could control a contract whether silver traded at $50 or $70. That created asymmetric upside. As price rose, the same margin controlled more notional value. Under the new system, as price rises, required margin rises proportionally. That caps leverage. It makes the trade less attractive to speculative capital. And when speculative capital exits, liquidity thins. Thinner liquidity means wider bid-ask spreads and more violent price swings on lower volume. That's exactly what happened between January 23rd and January 30th. Silver hit $120 on massive volume, then collapsed to $78 on even larger volume. The round trip took 3 trading sessions. Volatility like that doesn't come from fundamental reassessment. It comes from forced liquidation. Traders who bought at $90 with 9% margins were suddenly underwater at $120 when CME raised requirements again. They faced a choice: post more capital or exit the position. Most exited. That's the liquidation cascade. And cascades don't stop at break even. They overshoot to the downside because sell orders hit a market with no bid depth. Here's where the incentives show up. 6th, on January 30th, silver plunged from $120 to $78 in a single session, the largest percentage drop in decades. CME responded by raising margins again on January 31st, pushing non-heightened risk requirements to 15% from 11% and heightened risk profiles to 16.5% from 12.1%, and that's the hinge point. The timing of that margin increase reveals the actual priority. CME didn't raise margins to prevent volatility. They raised margins after volatility already happened. That's reactive risk management, not proactive. And it tells you what the exchange is optimizing for. They're optimizing for clearinghouse stability, not market efficiency. When prices move violently, the clearinghouse faces counterparty risk. If a member defaults on a margin call, the clearinghouse absorbs the loss. So they raise margins to reduce position sizes and force deleveraging before defaults occur. That's rational from a risk management perspective. But it also means the exchange becomes a volatility amplifier, not a stabilizer. Higher margins force selling, which pushes prices lower, which triggers more margin calls, which forces more selling. It's a procyclical feedback loop. Now overlay that with the Bloomberg Commodity Index rebalancing. Passive funds that track the index held 9.6% of their commodity allocation in silver through December. On January 9th, that allocation dropped to 3.9%. Funds had to sell approximately 60% of their silver positions to rebalance. That selling pressure hit the market at the same time CME margins were rising and China's export licenses were creating uncertainty about physical supply. 3 negative catalysts converged in a 2-week window. The result was predictable. Price spiked on the supply uncertainty, then crashed on the forced selling from index rebalancing and margin liquidation. But here's what makes this more than a temporary dislocation. The passive selling is finished. Index funds rebalanced. They're done. Margin liquidation has mostly cleared. Traders who couldn't meet 15% requirements have exited. What remains are physical holders, miners, and strategic buyers who don't use leverage. And those participants aren't selling. They're accumulating. You can see this in the divergence between futures open interest and physical delivery requests. Futures open interest dropped 32% from its January peak. Physical delivery requests through COMEX increased 18%. That's the opposite of what happens in a normal correction. Usually both decline together. This time, paper positions are getting closed while physical positions are getting opened. Who benefits? Physical holders with no margin calls, miners with fixed cost structures suddenly sitting on expanded margins, buyers using dollar weakness to accumulate hard assets without leverage, a mining company producing silver at $18 per ounce all-in sustaining costs. Just watch spot prices range from $78 to $120. Even at the low end of that range, margins are 80%. That's transformational cash flow. It allows debt paydown, dividend increases, and expansion capital. And it changes the supply response timeline. Normally, higher prices bring more supply, but silver is mostly a byproduct of copper, lead, and zinc mining. Only 30% comes from primary silver mines. So supply response is delayed and muted because it depends on base metal economics, not silver prices alone. Who gets boxed in? Leveraged futures traders facing margin calls at elevated price levels. Industrial users who delayed hedging and now need to lock supply at higher entry points. Funds tracking commodity indices forced to sell into volatility. An electronics manufacturer that budgeted silver costs at $35 per ounce at the start of 2025 is now facing spot prices above $70. They can't pass that cost increase through immediately. Contracts with customers were signed months ago at fixed prices. So they absorb the margin compression until the next pricing cycle. That's an earnings hit. And if silver stays elevated, it becomes a structural cost increase, not a temporary squeeze. What gets hidden? The spread between paper silver pricing on futures exchanges and physical delivery premiums. London Metal Exchange spreads between spot and 3-month forward contracts. The actual volume moving through the 44 licensed Chinese exporters versus prior baseline exports. Physical silver premiums in India hit 12% over spot in late January. In Europe, premiums ranged from 8 to 10%. Those premiums exist because physical supply is tighter than futures pricing suggests. Futures contracts are cash settled 98% of the time. Only 2% demand physical delivery. So futures price what traders think silver is worth. Physical premiums price what buyers will actually pay for metal in hand. And right now, those prices are diverging. That divergence is information. It tells you that paper pricing has disconnected from physical reality. If dollar index breaks below 96 and holds for 3 consecutive weeks, then foreign central banks accelerate reserve diversification into non-dollar assets, and that becomes unavoidable. Central banks hold 60% of their reserves in dollar-denominated assets. That's Treasury securities, agency debt, and dollar deposits. When the dollar weakens structurally, those holdings lose value in local currency terms. A central bank in India holding 100 billion in treasuries watches that position decline in rupee terms as the dollar falls. The rational response is to diversify into assets that aren't correlated with dollar strength. That means gold, silver, and other hard assets. We're already seeing this. Central bank gold purchases hit record levels in 2025. If dollar weakness persists, that buying extends into silver as a lower-cost alternative with similar monetary properties. If Federal Reserve signals rate cuts at the March meeting despite sticky inflation prints, then real yields turn negative across the curve, and precious metals become the only positive carry trade outside of emerging market debt. Real yield is nominal yield minus inflation. If 10-year treasuries yield 4.2% and inflation runs at 4.5%, real yield is negative 30 basis points. In that environment, holding cash guarantees losses in purchasing power terms. Precious metals don't pay interest, but they don't lose purchasing power to inflation either. That makes them relatively attractive. And if the Fed cuts rates while inflation stays elevated, real yields go deeper negative. That's the setup for sustained precious metal strength, not a spike. A grind higher over quarters, not weeks. If Chinese export licenses tighten further through administrative delays rather than explicit bans, then physical silver supply contracts, while industrial demand from solar and defense applications continues growing at double-digit rates, and spot premiums over futures widen past sustainable arbitrage levels. Solar panel installations are projected to grow 23% annually through 2030. Each gigawatt of solar capacity requires approximately 100,000 ounces of silver. Defense electronics and satellite systems are expanding as geopolitical tensions drive procurement budgets higher. Silver demand from these sectors isn't price sensitive. It's specification driven. They need the material regardless of cost. So if supply tightens incrementally through licensing friction, demand doesn't decline. It just bids higher. And that higher bid shows up in physical premiums first, then eventually pulls futures pricing higher as arbitrage firms step in. If you hold cash, understand that negative real rates erode purchasing power faster than nominal interest accrual. Dollar depreciation isn't uniform across all currencies. Japanese yen strengthened from 160 per dollar down to 148 in 3 weeks. That's the currency benefiting from dollar weakness right now, not the euro. The euro gained 3% against the dollar. The yen gained 8%. That difference matters if you're holding cash equivalents or short-term bonds. Currency movements can overwhelm interest rate differentials over short-time horizons. A money market fund yielding 5% loses money if the dollar declines 6% against the currency you ultimately spend in. If you hold risk assets, recognize that precious metals aren't moving on speculation anymore. This is balance sheet reallocation by institutions managing currency exposure. When silver dropped $42 in one day and gold fell from $5,300 to $4,800, that wasn't profit taking. That was forced liquidation from margin calls. The fundamentals didn't change. The leverage did. Understanding that distinction changes how you interpret volatility. Forced selling creates opportunity for unleveraged buyers. It pushes price below fundamental value temporarily because sellers aren't motivated by outlook. They're motivated by margin requirements. Once that selling exhausts, price recovers toward fundamental value. That recovery might take weeks or months, but the direction is predictable if the fundamentals remain intact. If you rely on a paycheck, track import prices on electronics and vehicles. Silver sits inside every semiconductor, every solar panel, every EV charging system. When supply tightens and prices spike, those costs get passed through with a 6 to 9 month lag. The inflation you'll see in consumer goods later this year is being priced into commodity markets right now. A smartphone contains roughly 0.2 grams of silver. A laptop contains 0.5 to 1 gram. An electric vehicle contains 25 to 50 grams depending on battery size and electrical architecture. Those seem like small amounts. But multiply by unit volumes. Global smartphone production runs 1.4 billion units annually. That's 280 million grams of silver, or 9 million ounces. EV production is approaching 14 million units annually. At 35 grams per vehicle, that's 490 million grams, or 15.7 million ounces. And those are current volumes. Projections for 2030 show EV production doubling. Silver demand from that sector alone climbs to 30 million ounces. Where does that supply come from if Chinese exports tighten and mine production grows at only 2% annually? Don't chase price moves without understanding the margin structure underneath. Silver at $120 with 15% margin requirements means different risk exposure than silver at $70 with 9% margins. The notional value is higher, but the leverage is lower. Do the math. At $70 with 9% margins, you control $77,000 of silver with $6,300. That's 12 to 1 leverage. At $120 with 15% margins, you control $120,000 with $18,000. That's 6.6 to 1 leverage. The leverage got cut in half even though the price went up. That changes the expected return profile. Higher prices don't automatically mean better returns when margin requirements rise proportionally. Track the dollar index weekly, not daily. The 3-month moving average matters more than single session volatility. Right now that average is declining, and it's been declining since November. That's the trend. Daily moves are noise, weekly moves are signal. The dollar index fell from 106 in September to 97 in January. That's a 9% decline in 4 months. The 3-month moving average is now trending below the 6-month moving average. That's a technical confirmation that the decline has momentum. It doesn't mean the dollar can't rally. It means rallies are likely to be corrections within a downtrend rather than reversals of the downtrend. Trade accordingly. Assume physical premiums lag futures pricing by 2 to 4 weeks. When paper markets crash, physical markets don't move in lockstep. Dealers need time to adjust bid-ask spreads. That gap is where real price discovery happens. A coin dealer holding inventory bought at $110 doesn't immediately drop asking prices to $80 just because futures crashed. They mark down slowly, testing demand at each level. And if buyers step in at $95, that becomes the new physical clearing price, regardless of where futures trade. Over time, arbitrage firms narrow that gap by buying futures and taking physical delivery. But that arbitrage takes weeks to execute. During that window, physical premiums reveal what real buyers will actually pay. And right now, they're paying 8 to 12% over spot. That premium structure tells you the crash was driven by paper liquidation, not physical selling. Treat CME margin changes as the signal, not the headline economic data. When exchanges raise margins, they're responding to volatility they've already measured in their clearing systems. That's forward-looking information, not backward-looking statistics. Margin increases predict continued volatility. They don't stop volatility, they confirm it. Use that information. When you see margin requirements jump 15% in 2 weeks, that's the exchange telling you they expect price swings to continue. Position size accordingly. Don't assume the volatility is over just because prices stabilized for 3 days. The margin structure is telling you otherwise. Keep optionality. This isn't the time to go all in on single positions. Dollar weakness benefits hard assets, but it also creates currency dislocations that reverse without warning. The Japanese yen rallied 20% in 3 months, then gave back 6% in 1 week. Volatility runs both directions. Preserve capital flexibility so you can respond to opportunities as they develop. A 50% position leaves room to add if your thesis confirms. A 100% position leaves you fully exposed if your thesis breaks. And in markets moving this fast with this much structural uncertainty, thesis breaks happen. Not because the analysis was wrong, but because the variables changed faster than the analysis could adapt. So here's what nobody's answering yet. If the dollar continues weakening and physical silver tightens, but CME keeps raising margins to suppress future speculation, where does price discovery actually happen? Does it move to London? Does it move to Shanghai? Or does it fragment across regional markets with pricing disconnects that last for quarters instead of days? We're watching a market structure shift in real time, and the participants who understand that aren't waiting for confirmation. They're already repositioning. The London Metal Exchange trades silver through unallocated accounts, where title transfers electronically without physical movement. Shanghai trades through physical settlement, where metal actually changes hands. COMEX sits between those extremes, offering both cash settlement and physical delivery. If COMEX margins keep rising, speculative volume migrates to London, where leverage is higher and margin requirements are lower. But London lacks the transparency of COMEX. Positions aren't publicly reported. Open interest is opaque. That makes price manipulation easier and detection harder. If volume shifts from a transparent exchange to an opaque one, price discovery degrades. And degraded price discovery means wider spreads, more frequent dislocations, and less efficient capital allocation. Shanghai operates under capital controls that limit foreign participation. That creates a persistent premium or discount relative to Western markets, depending on domestic Chinese demand. Right now, Shanghai silver trades at a 2 to 3% premium to COMEX. That premium exists because Chinese buyers can't easily access COMEX metal, and COMEX participants can't easily arbitrage into Shanghai. If Chinese export licenses tighten further, that premium widens. And if it widens past 5%, it starts pulling physical metal away from Western markets into Chinese markets. That drains available supply from COMEX warehouses and London vaults. Inventories decline and spot premiums rise to reflect tighter physical availability. The question isn't whether silver goes higher or lower next week. The question is whether the pricing mechanism itself remains centralized or fractures into multiple regional equilibriums with arbitrage gaps too wide to close. That's the file that's still open. Because once that fragmentation sets in, there's no central reference price anymore, just competing markets with competing incentives, and that changes everything about how capital allocates across metals, currencies, and sovereign debt. The architecture is shifting. The moves you're seeing are symptoms, not causes. The cause is a reordering of how value gets stored and transferred when the dominant reserve currency enters a structural weakening phase. That reordering doesn't happen smoothly. It happens through dislocations, volatility spikes, margin liquidations, and forced rebalancing. We're in the middle of that process right now. The outcome isn't certain, but the direction is becoming clear. Hard assets are repricing relative to paper claims, and that repricing has